All right, what do we make of this quarter from Palo Alto Networks? The best-of-breed cybersecurity operator. It's been a huge winner for my charitable trust until this evening. While the stock got clobbered after hours, maybe it'd be wrong to assume that management said business is doing badly. In fact, Palo Alto beat expectations almost every line for the reported quarter, including a 22-cent earnings beat off the $1.16 basis. Even as Billings, I think, did come in light. Problem was the guidance, but even there, it was mainly the Billings guidance that disappointed. Management explained that this was a technical result based on how the company accounts for customers that need financing to pay for their orders. On the conference call, they stressed that this is not a demand problem. It made me feel better about the situation, but I have to admit I'm confused. That's why we need to dig deeper with Nikesh Arora, the chairman and CEO of Palo Alto Networks, find out more. Mr. Arora, welcome back to Mad Money. How should we be feeling about these numbers?
Thank you for having me, Jim. I'm surprised to hear you're confused. You're never confused. Jim, we had a great quarter. We beat almost every metric that was out there. Phenomenal profitability, phenomenal revenue growth in a market that is extremely volatile. I think the market is getting marginally spooked by the fact that we adjusted Billings guidance down. I think it's important to understand. Look, our business is a hybrid of ACV and TCV, or people who pay annually and people who pay us upfront over 3 years. And as the interest rate environment continues to stay higher for longer, we're noticing that customers want to have longer conversations around when they will pay us and whether we should finance them or not. And that cosmetically impacts the Billings number, and hence the market's getting confused. But there's nothing to be confused about. There is tremendous demand out there. Cybersecurity attacks are unfortunately going up. We've never seen a quarter as active as Q1 for us in the last 3 months, where people are seeing more attacks. We've never seen more customers sitting down and trying to derive platformization strategies. So the demand function is strong. Our revenue forecast has not changed. Our profitability forecast has gone up. So from our perspective, we had a great quarter, and the prospects are bright.
Nikesh, that would mean that the people who are selling the stock down 20 points simply don't understand how business is and are making a big mistake. At the same time, the crowd is rarely as wrong as that. And I think some people feel that this was just a light number and that you have some problems, say, with firewall business that are similar to Fortinet, and that what really is going on here is that it's just getting harder and harder to close deals in a business that it shouldn't be because it's cybersecurity.
Well, I think, Jim, we should parse that a bit more. We have been very consistent in the last 12 to 18 months saying that we expect that the hardware business or product business out there is growing at 0 to 5%.
Right.
We did 3% growth. We've been very consistent. There are people out there who show larger numbers and are going to show smaller numbers. We stayed down the middle. We managed to make sure that we manage our price hikes, we manage our supply chain, we manage our backlog in such a way that we can consistently deliver that. So I don't think the hardware woes of other people in our industry are pertinent to us. I think from a customer deal perspective, as I said, we have the ability to finance deals. We have $7 billion of cash on our balance sheet, so we can finance deals. I'm telling you, we don't have customers who are saying we don't want to do business. It's just that they negotiate payment terms. And here's an interesting metric. Our duration has gone down this quarter from last quarter, which means our deals are shorter. When deals are shorter, you get lower billings. Doesn't mean there are less deals in the market. You're still doing the same amount of business, saying, and my churn is low, so I don't mind if a customer says, I'll sign up for 1 year, I'll come back later. I'm like, no problem. You'll be there next year.
I have an idea. Okay, so I see you bought back $67 million worth of shares last quarter, $227. You've got a gigantic amount of cash. Maybe this is the opportunity to show the people who are just throwing their stock away because they do not understand what you just said, that, you know what, here, sell it to me. I got all the capital. You went out of my stock. I think that's terrific. I don't want you as my shareholder if you don't understand what I'm doing.
Well, Jim, we have a evergreen stock buyback approval from our board in the vicinity of $1 billion. And our treasury team is very diligent about how they look at the market, and they will opportunistically see when they believe that we should be in the market, and they'll do what is needed.
Fair enough. Okay, so let's talk about the threats. We've got, by the way, we have President Xi here right now. I mean, does that mean that China's not a threat because he's here? And how about what's going on in the Middle East? I mean, it would seem to be that this is the greatest disruption. And then tell me what happened at Clorox. Tell me what happened at the casinos. Because it seems to me that, I mean, I would pay you anything if I ran a business right now and I was worried about cybersecurity.
Well, Jim, all I will tell you is that the cyber activity is so high that we got the most number of calls to our incident response team in the last month than we've ever had at Palo Alto Networks. And we're not the biggest player in incident response, so I can only imagine what some of our other peers in the industry are seeing from an incident response activity. Yesterday, we announced a program that for our top 2,000 customers around the world, we will give them free incident response if they get attacked. Call us, you're a customer of ours, we'll come and help you. We'll worry about how to deal with the economics later. So it's free for the first 250 hours because we want to go support our customers because we think the activity is bad and it's going to get worse. So that's why I'm saying the demand function is there. There are people out there who are getting breached. We have to be there for them as their partner of choice.
Would you ever make that same deal to people who aren't using you, but realize that perhaps that they're not as good a vendor and they'd rather be with you from now on?
Well, you know, we will not return every phone call. So if people call us, we'll be there for them. And if they're not a customer, we'll figure out a way to help them for sure.
Now, we hear about these situations where there are help. This is something that Toppington told me at Okta. You've got these people at the companies. They all want to help clients. They all want to help each other. And they give away information freely that they shouldn't. What can Palo Alto do about people who just don't understand that you can't just help everybody anymore?
Well, we can't solve for people who are not going to pay attention to how they need to be confidential about their data. But what we can do is we can work with most of our large customers and partners out there and prospects out there in making sure they have a robust cybersecurity strategy, a strategy that is connected to their technological evolution strategy, make sure that they're not going to be out there and easily attacked. We'll make sure that if they do see activity, we'll be there to support them. We have various services. We have services where we'll help monitor their environment with them, so they don't have to get the we can take the complexity out of it from them. We have partners across the industry now with many system integrator companies out there, which we can partner with, who will actually do that work with us for them. So there's tons of opportunities. I think the important part to understand is that as we go through this technological evolution, as we start paying more and more attention to AI, we're going to have more and more threat vectors show up. We see adversaries using AI now to attack customers. So this is happening, it's real time. People need to get their technology stacks up to speed, more robust, more in the next generation. That's something we all have to do across the board.
All right, one last question.
Otherwise, we won't be successful with AI.
Understood. One last question. Going forward, should we not be focused on Billings? Should you just say point blank, that is not representative? This is the way we have to start thinking out if we're going to understand how to value Palo Alto.
Well, Jim, look, at the end, what you care about is EPS and cash flow.
Yes.
EPS is a consequence of revenue that you deliver, and cash flow is the consequence of what's left over after you've spent everything that you need to spend. We have shown the biggest collection of cash this quarter, close to $1.5 billion. We have shown revenue growth north of 20%. Our EPS, we have shown operating margin of 28.4%, which is 760 basis point improvement from last year. So we are hitting all the profitability and cash flow metrics in the market. Billings is an indicator of revenue in the future. And the better indicator of revenue in the future is RPO, remaining performance obligations, which we grew at 26%.
I absolutely agree with you. That's how
It doesn't take a math wizard to figure out what's going on.
I've learned that in the last 2 years, so perhaps I'm a little less confused after I've been speaking to you. Fair enough? Thank you. That's Nikesh Arora, Chairman and CEO of Palo Alto Networks, PANW. The stock is down. You just heard another version of what people are doing and selling off of. Maybe they're making a mistake. Mad Money's back after the break.
Coming up, more from today's top tech movers. Cisco checks in fresh off earnings. Next.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.